It's fair to say the past couple of years on markets have been anything but typical. There's been a coordinated fiscal and monetary policy support really underpinning this economic recovery that we've seen in markets around the world. But of course, the question has been, how long can this go on for? For how long can J Powell's money printer continuing to flood the system with liquidity? How long can these quantitative easing and emergency time crisis measures really be underpinning this market? Well, it looks like we're starting to move into this period where tapering is going to become at the forefront of the discussion. We've started to have it telegraphed from the Federal Reserve as well as other central banks around the world. Some of the leading central banks have started to raise rates. And of course, the big question is, what happens from here? What does tapering as well as potential interest rate hikes mean for the markets? And in today's video, we're going to have this discussion. If you do enjoy the video, don't forget to hit the thumbs up button. Feel free to share it out as well. If you're new here, welcome. We make daily videos. So if you haven't yet, make sure you've subscribed and turn your bell notifications on. And so before exploring tapering and some historical examples of tapering and what it meant for the markets when it was instituted, it makes sense for us to take a step back and have a bit of a think about the current state of play and where do we sit. Of course, we know that we've seen an improving economic outlook. If we wind our minds back to 12 months ago, probably not many people at all would have anticipated that we would be where we do currently sit. There has been significant fiscal support from governments around the world, as well as significant monetary policy support. If we think about the current support underpinning these markets, of course, we've seen central banks around the world really slash rates to record low interest rates, and they've forecasted these to stay lower for longer, though of course this is a discussion that's starting to pick up pace. And along with that as well, there's been significant quantitative easing from many of these central banks. Over in the US, the Federal Reserve, led by J Powell, have been buying back $120 billion a month on the markets. And of course, this has worked to suppress yields and to really lower the cost of borrowing. But over the past period, with the improving economic outlook, inflation is high and is sustained high. The question has been, where do we head from here? Of course, we've had that discussion surrounding tapering. Is it transitory or more systemically embedded? We've heard from the Federal Reserve that they believe it's transitory. But the question has been, as we start to move out of this emergency crisis period, how do we take away these emergency crisis supports without destabilizing the economy and the recovery as well? There is one uncertain factor as well. We know that the Delta outbreak has caused a bit of havoc. There's been lockdowns around the world. We know that the Delta outbreak has put a bit of a delay on the recovery. Though many of the central banks have stated that it hasn't derailed the recovery, it's only delayed it. But of course, the question is, with some of this lost demand, has it been delayed to the future? Or have we actually lost some of this? It's going to be an interesting time. We'd love to know your thoughts on it all, so drop in a comment below what you think about the current economic recovery and what do you think tapering could mean for the markets. And of course, a reminder that I'm not a financial advisor and nothing we discuss is financial advice. This is all just general discussions to be that starting spot for you to do your own research from. So then the question is, tapering or tightening? I think when people think about the word tapering, many instantly think, oh, this must mean that interest rates are going to start to rise. What will this mean, of course, for the cost of borrowing? But of course, the range of different other factors that will play out on the market. However, we have to know that tapering is not tightening. And in fact, the Federal Reserve and other central banks around the world, including the RBA, have really done their best to try and delineate these two processes. Tapering, of course, has to do with the paring back of bond purchases surrounding the quantitative easing that's been instituted during this period. And tightening, of course, is referring to the potential rate hikes that will have to come over time as a way that will help to curtail and slow down growth so that it doesn't get out of control and start to run rampant. If we have a look at some of the tailwinds and some of the headwinds surrounding the current state of play on the markets, on the positive side, we know that there's been growth in earnings that really has been sustained over this period. It's been a stronger economic recovery than many would have initially given credit for. We know that vaccination rates are rising as well, and the world's starting to reopen, which will be a huge boost for many different sectors of the economy as well. And along with that, there's many healthy household balance sheets. We know that there was limited places to spend over this past period, but income stayed at relatively high levels, particularly with the amount of fiscal support. And so as a result of that, once the world starts to reopen, there is hopes that consumer spending will stay elevated, which of course will continue to boost the economy. However, there are headwinds. We know that further outbreaks and lockdowns, of course, could be headwinds, and we've started to see that with the Delta outbreak. We know there are supply chain disruptions, and this has fed through as well to inflationary pressures and cost pressures as well. Along with that, there has been some labour shortages in some certain pockets of the market, so it'll be fascinating to see how we go. It is worth as well reconsidering the fact that when we did come into this period, we have been in a lower growth environment really since the GFC in 2008. As you can see on this visual on the right, of course, growth has dipped significantly through 2020. We're expecting a significant uptick in 2021, but it will be interesting to see how much that growth upticks and where we're going to head over this next decade as we do head into the 20s. There is a lot of discussion in the short term about inflationary pressures and of course concerns that inflation may be running rampant. But on the other side of the coin as well, there is questions about have we reached peak growth at this stage? Is this the best that it's going to be? Of course, nobody has the answers, but we will continue to watch this dynamic play out moving forward. And so with that understanding that the Federal Reserve and J Powell has started to forecast that tapering may be on the horizon, we know that the next review will be in early November. So that could be the earliest stage that we actually see this tapering come into play. Question is, have we seen this before? Many people will be familiar with the taper tantrum that happened in 2013, but we have an even more recent case of it as well in the back end of 2018. So if we're thinking about the taper tantrum in 2013, this of course was that third wave of QE out of the GFC, out of 2008's recession. There was an initial indication of the reduction in asset prices by the then Fed chair, Ben Bernanke, that spooked markets. We saw the 10-year yield rise by over 100 basis points over that past period. There was significant rise in volatility. However, after an initial pullback of 5 to 6% on the S&P 500, it did go on to make significant highs and significant gains into the back end of 2013. However, the taper tantrum is an indication about what can happen and the spike in volatility that can result. And we see central banks around the world here trying to telegraph the tapering and the potential paring back of support for the markets as early as possible so that they can avoid spooking the markets in this 2021 period. And then of course, casting our minds back to 2018, we know that there was a December taper where J Powell mentioned that it would almost be like we're on autopilot. There was a bit of concerns from the markets that there was not enough flexibility. There was a significant drop-off in the share prices around the markets pretty rapidly over a 2-week period before the Powell pivot followed, where he introduced more flexibility and of course more patience for this. So it is worth noting that as we start to see these discussions for tapering and tightening and paring back of the monetary policy measures that we've seen supporting the market over the past couple of years, volatility in the short term is a potential result. So it is worth being aware of that. And so then the big question is, where to from here? We recently had the jobs report over the past month. There was a consensus of around 500,000 jobs added. However, the actual was actually just under 200,000 jobs. It was the second month in a row that there was a downside surprise to the jobs report. It probably puts the Fed Reserve in a decent position because it wasn't so hot that they were alarmed and they were concerned and they would have to think about how they could curtail growth. However, of course, it does give them a little bit of wiggle room. It still gives them the possibility to start to taper with the November review, as mentioned, but it does mean that they don't have a huge amount of concern that they may need to rise rates earlier. And that's really what the market is most likely to be concerned about. We know that this was the last jobs report before November 3rd, but the next question is, after tapering, which it looks like we may see tapering commencing soon from November potentially, of course, it's worth noting that tapering is not going to be an immediate pulling back of the punch bowl. It's going to be a slow period. It will go out over many months. There will continue to be liquidity added to the system. However, we're not going to see this expansion of the balance sheet that we've seen over this past period that's been really supportive for the markets. Of course, it is going to be a delicate balancing act because markets have been used to this type of support, but it does look like the central banks are aware of the fact and they're going to try and play this as best as possible and give it enough room and runway ahead so that there isn't those shocks or spooks for the market. It is worth noting that the question to tighten, the central banks have forecasted the key conditions that they're searching for. They want to see inflation sustainably in that 2 to 3% band. They're not looking for just a one-off. They want to see that significant sustained inflation, but they also want to see full employment and a return to a tighter labour market. The market's currently pricing in a November 2022 rate rise. Of course, we saw the dot plots over the past period actually see an even split between 2022 to 2023, which is the first time we saw that from the Federal Reserve. It's an interesting period. Of course, we know that the money printer memes over this past time have been discussing all of that significant liquidity and support from Federal Reserves and central banks around the world. It is a positive because it does mean that we're moving into more normalized market conditions. Of course, there is the potential for volatility, but it's something that we'll continue to monitor and watch moving forward. If you did enjoy the video, don't forget to hit the like button. Feel free to share it out. If you're new here, welcome. We do these videos daily, so make sure you've subscribed and turn your bell notifications on so you won't miss any of our daily episodes. Really appreciate you joining us. Let us know what you thought with a comment. For now, stay well and happy investing.